Good evening, students. Welcome to the session. So today we have an art taxation class, and I hope you have revised after a long time. We are having the class together, and I hope that you don't have any doubts concerning whatever classes that we had done in the past. And I also know that this is going to be your last revisionary class as far as the topic revisions are concerned. You have then the two amendment classes with respect to the amendments which are there to the Finance Act, the Judicial and the Statutory Update, which are applicable for your September attempt. Yes. So let us just proceed ahead with the lecture, and let's start with the NR taxation. Okay. So here I want your participation as we have been earlier also doing. First, we'll talk about the residential status of the individual. So what is the criteria for residential status of the individual? Yes.
Now, first we will check the basic condition.
Uh-huh. What are the basic conditions?
Yeah, if he stayed in India is equal to or greater than 182 days in the previous
Correct.
year.
Correct. So, for the residential status, the basic condition is that you have been present in India for more than 182 days during the particular financial year, right? So, that is the first condition which is there. That's the first basic condition that we start with, okay? Or either this condition A, or the second condition is what?
Second condition is greater than or equal to 90 days in a previous year and
90 or 60? 60, right? Not 90.
365 days for 4 years immediately
Correct.
preceding previous year.
Correct. So,
Is both
the
conditions to
current,
be satisfied?
correct. In the current year, 60 days, and in the last four preceding previous year, more than 365 days, right?
Yes,
More
ma'am.
than,
Yes.
greater than, equal. So, 60 days, and so either of the condition, like this condition B, is having the two parts, and both of which requires the satisfaction. The condition A, which is there, that is saying that only 182-day condition. So A or B, whatever it is, like you satisfy either of this, you become the resident of India. Now, what is
Yeah.
the importance of, like, determination that whether you are a resident or you are a non-resident? Like, why is it important to determine this as a first step before you even get into the Income Tax Act?
Because based on the residential status only, the income is taxed.
Mm-hmm. So when you say that the income is taxed, so what do we understand by that? Like, how it is different for a non-resident, and how is it for a resident?
Say example, the resident and non-resident, the global income are taxed. For
Correct.
non-resident, yeah, non-resident only income arising or accruing from India or income received in India only is taxed on the non-resident case.
Correct. Absolutely. So very good. So basically, then what we are trying to say, students, is that based on the scope of total income, right? So the scope of total income is based on what is your residential status. Whether you are resident or a non-resident, your scope of total income will change, right? For a resident, the global income gets taxable in India. Whereas for a non-resident, only the income accruing or arising or received or deemed to be received in India is taxable. Isn't it? So, in terms of that, whether a country can tax you, it is dependent on whether you are a resident of that country and where is the source of income. If you're not a resident, then basis the source of income in that country, the country can tax your income. Are we clear? So that's the reason why it is important to determine where is your residential status or what is your residential status. Where are you a resident? Fine. Now, as far as this first condition is concerned, which is stay in India for greater than equal to 182 days, that's fine. As far as the second condition is concerned, stay in India for greater than equal to 60 days, there are two exceptions to these conditions, or rather three exceptions that we are going to talk about. The first exception is that this entire condition, the second condition, the B, is not applicable if the Indian citizen is there who leaves India for the purposes of employment outside India. Indian citizen who is going outside India for the purpose of employment. So let us take an example. Let's say I am working here for a really long time and now I'm like, feeling like, no, I want to, explore the global market, right? And I have done a lot of Indian tax, Indian audit. Now I want you to see like how globally the taxes are, how globally the financial reporting is. So I take up the employment outside India in, let's say, some foreign company, right? I was all this while an Indian resident. Now I feel like, no, I have to explore, I want to gain the experience of the international market also. So therefore, I'm taking the employment outside India. So in that particular case, what will be my residential criteria? Like what will be the number of days that you will consider for me to determine my residential status?
182 days.
Correct. You will not look at this condition at all. Because if I'm going out for employment, if I've always been a resident of India, I would be present at least for 60 days. Like it is possible that, I may leave for like US employment after September, after October. So 60 days to will easily get satisfied. And I have been in India, I've never went outside India for more than, like 10, 12 days, 15 days. So obviously my stay in India would be more than 365 days for 4 preceding previous year. That's the reason why for Indian citizens who are going outside for employment, only this A condition is being considered. Fine. Second is an Indian citizen who leaves India as a member of crew of Indian ship. So if I'm not going outside for employment, but I'm going as a crew member of the Indian ship, then in that particular case, I will be considering only the first condition. Fine. What if like I'll tell you that, okay, I am not a citizen of India. I'm a US green card holder. And I have been resident in India all this while. Fine. Now, but let's say for example, my parents are Indian citizen. I'm not an Indian citizen. My parents are Indian citizens. I'm not Indian citizen. But I've been staying here for quite a while. And now I am thinking to go to some other country to gain the experience. So how many days will you consider for me? Yes. I'm not an Indian citizen. My parents are Indian citizen. I've been resident in India for all this while. Now I feel like I'll go to some other country for the purpose of the employment. So what is the number of days that you will consider for me?
182 days, ma'am.
No. We'll consider both the conditions, isn't it? Because even if my parents are Indian citizen, here they talk about the Indian citizen, not the person of Indian origin. There's a distinction between the two. Just because my parents are Indian citizen, I do not become Indian citizen. I can still be the citizen of some other country. Had they said that Indian citizen or PIO who leaves India for the purpose of employment, then you would have considered 182. Here they only talk about the Indian citizen, not the PIO. Yes or no? So here we will consider both the conditions for such a person because the exception will not apply because I am not an Indian citizen. Yes, this exception is only there for Indian citizens. Are we clear?
Yes, yes, madam.
Yes, ma'am.
Yes, ma'am.
Yes. Then the third exception is for the Indian citizen or the PIO who is outside India, comes on visit to India, and who has the total income from the Indian sources less than rupees 15 lakhs. So here they talk about the PIO. PIO is what? What is the meaning of the person of Indian origin?
Who is a lineal ascendant by whom born in undivided India.
Correct. Whose parents or grandparents were born in undivided India, right? So that's the PIO. So here they say that Indian citizen or PIO who is always outside India is coming on visit to India. So here, even if, let's say, for example, I'll tell you that, look, my parents are citizens of India. I am not citizen of India. I am staying outside India and I'm coming on visit to India. So here, how many days will you consider for me? 182. So here it not only includes the Indian citizen but even the PR. And this is for the person who is always outside India and is coming on visit to India. Are we clear? But his total income from the Indian sources should be less than rupees 15 lakhs. Are we clear? So this is exception number 1. Exception number 2 is for the Indian citizen or PIO who is outside India coming on visit to India but has the total income from Indian sources more than rupees 15 lakh. For him, we will consider instead of 60 days, 120 days. But we'll consider both the condition, either 182 days or 120 days and stay in India for greater than equal to 365 days. So here, instead of 60, we will consider 120. Are we clear about the residential status of the individual?
Yes, ma'am.
Yes, ma'am. Okay. Now there is something called this concept of deemed residency. Any idea about that? What is it? Who is the person who is a deemed resident?
Ma'am, Indian citizen having total income greater than 15 lakhs, but it is not liable to tax in the country of the resident.
Correct. So any Indian citizen, here they do not use the word PIO, only the word Indian citizen. Having the total income from the Indian sources. We are not talking about the global income. How can you tax the global income? How can you consider the global income when you have not even considered that whether this person is a resident or non-resident, right? So we are only talking about the total income from the Indian sources. If it is more than 15 lakhs and I'm not liable to tax in the country of my residence, where I'm residing at this moment, I'm not liable to tax. What do I mean by that I'm not liable to tax? What do we understand by that?
Madam, in the country where he is resident, in that country he is not taxed for any income.
Correct. So
in that case, any Indian source of income, if it is greater than 15 lakhs, then he will be considered as a deemed residence.
Correct. So what do we mean by liable to tax? Liable to tax means that a particular person in that particular country is not having the income tax liability. Right? Is not having the income tax liability. So there is no income tax imposed on such person under the law of that country. Or if that person has been exempted from the income tax under the law of that country. So even if I have not stayed in India for even one day, I would be still considered as a deemed resident of India. Right? A classic example of this is the, let's say, resident of UAE. UAE does not impose the personal income taxes. Right? UAE does not have the personal income taxes. So a person who is at the moment a resident of UAE but is a citizen of India, if he is not paying any taxes in UAE, he can be considered as a deemed resident of India if his Indian sourced income is more than rupees 15 lakhs. If his UAE income is more than 15 lakh, he will not be considered as resident of India. If its Indian income is more than 15 lakh, then he will be considered as the resident of India. Are we clear? Now, once you are considered as a resident of India, there is something called as resident and ordinary resident and resident and not ordinary resident. And for that, there are two additional conditions, both of which needs to be cumulatively satisfied. Are we clear? So, what is the difference between the ROR and the RNOR?
ROR is a global income taxable. For RNOR, the thing is that income accruing or arising in India and income received from India and income accruing or arising outside India from a business controlled or set up in India only is taxable. That's the only difference.
Correct. So, for the ROR, the global income is taxable. For RNOR, only the income which is accruing or arising in India, income received or deemed to be received in India, and income accruing or arising outside India from the business controlled or profession set up in India is taxable. So, what are the conditions for the ROR? Residence in India for 2 out of 10 preceding previous years and stay in India for more than greater than equal to 730 days in the 7 preceding previous years. If that be the case, you will be ROR. If you fail to satisfy any one condition, you will be RN. Clear? Now, again, there are exceptions to the ROR, RNOR also. A deemed resident is always going to be RNOR. A deemed resident is always going to be RNOR. Now, you should ask me a question, ma'am. If a deemed resident is always RNOR, listen this very carefully. If a deemed resident is always RNOR, what is the purpose of calling him deemed resident? Because even if he was NR, let's say even if he was NR, he was not a deemed resident. If this person who is not liable to tax in, let's say, UAE, is now considered as deemed resident because of this provision, he is not visiting in India for even 1 day. Even if he was not a resident, even if he was not a deemed resident, when this provision did not exist, even in that case, only his Indian income should be considered as taxable, right? Income accruing, arising, received, deemed, received, right? Now, when I'm saying that the deemed resident is always RNOR, in that case also his income accruing, arising, received, deemed to be received is only taxable. So what is the idea behind introducing the provision of the deemed resident? Are you getting my question? My question is that what the legislation achieved the purpose by creating this concept of deemed resident, because even when a person is not a resident of India, he is still taxable on his Indian income. When I say that a person is deemed resident, he is considered as RNOR always. And RNOR is also taxed only on his Indian income. So what is the objective that the government achieved by introducing this provision or the concept of deemed residency?
Because for Indian citizen, the government giving some exemption like 15 lakhs. For non-resident, all the income is taxable. There is no exemption is there.
No. See, 15 lakh is to determine that whether you will be deemed resident or not. It is not an exemption that you have as an income category. So the 15 lakh, this is there. It is saying that if you have the Indian income more than 15 lakh, then if you're not liable to tax in the other country, you'll be considered as deemed resident. It doesn't say that up till 15 lakh, we'll not tax your income. So up to 15 lakh, you'll be considered non-resident. It's not that we are saying that it will not be taxable.
Ma'am, tax rate will be different for non-resident, ma'am.
Very good. So the tax rate for a resident and the tax rate for non-resident is different. For certain,
for Indian citizen, the government giving some relaxation on this.
Correct. So there are differences between the tax rate for a resident and non-resident. It's not that, for an Indian citizen, they are giving some concessions. In fact, for non-resident, they have like reduced tax rates. So if you are earning FTS, royalties, they are taxable at a lesser rate of 20%. Right? Under section 115, even for interest, even for dividends like that. But if you are an Indian resident, right, your tax rate is little higher. So that is one important distinction. Secondly, if I would have not created this concept of deemed residency, there is still a distinction between the NR and the RNOR. So for RNOR, this category of income is taxable. What is this category of income? Accruing or arising outside India from the business controlled in or set up in India. If I'm a non-resident, India will not be able to tax my business income, which I am earning from the business controlled in India. But if I am RNOR, India will be able to tax income accruing or arising outside India from a business controlled in or set up in India. Are we getting this particular point? So this whole concept of deemed residency was created because Indian government realized that there are certain high net worth individuals who are trying to arrange their number of days of stay so as to become the resident of any particular country where there is zero tax. But in effect, they are earning the income from controlling the business from India. And that is the reason why they created this concept of deemed residency. They are not saying that we'll tax your global income. They are saying we'll consider you RNOR so that we were able to tax these A and B. But if you are now going to be considered as RNOR, we'll also be able to tax the C income. Are we getting this point? Yes or no?
Yes, ma'am. Clear.
Yes. Clear? Okay. What is the next exception? Indian citizen or PIO who has total income more than 15 lakh from Indian sources and who is coming on visit to India, he will also be considered as RNOR if his stay is more than 120 days, greater than equal to 120 days and less than 182 days. So for him, we will not consider the other two A and B condition. We will only check that if his stay is more than 120 and less than 182 days. Clear? So this is a distinction between the ROR and RNOR. ROR, all the income globally taxable. RNOR, these three, and NR, only the income accruing or arising or income received in India. So this RNOR category is only created so that it doesn't happen that, when you are becoming a resident in India for the first time, your global income gets taxed. We are giving you relief for 2 years until you become the ROR. And in between that period, we'll only tax these things. Clear? Any questions so far? Fine. Now, how is the residential status of the HUF determined? Yes. When is the HUF said to be the resident of India?
Control and management. If it is in India, wholly or partially, then it is resident in India.
Correct. Control and management, wholly or partly in India, it is a resident of India. HUF can also be ROR, RNOR, depending on the residential status of the Karta.
Karta.
Correct.
If the Karta is ROR or RNOR, then HUF also will be treated like that.
Correct. Same way for the partnership firm, LLP, AOP, BOI, the residential status is determined on the basis of where is the control and management of the affairs. If it is wholly or partly in India, it will be considered as the resident of India. But of course, the partnership firms, AOPs cannot be considered as ROR or RN. Are we clear? Now, the next important one is the residential status of the company. Now, I remember I have done the revision with you on this particular point, that what is the difference between a domestic company versus a resident company? We have done this point.
Ma'am, resident company is Indian company who set up that Indian Companies Act, and also the foreign company having the place of effective place of management. Those we can call it as a resident company.
It's fine, but what is the importance of like resident company versus the domestic company?
Resident company, the scope of total income, determining the total scope of total income, and for the domestic company for the determination tax purposes.
The purpose of resident companies for determining the scope of total income, and domestic companies for determining the tax rate.
Correct. Yes, very good. So, if you remember, we had this discussion, like a month back when we were talking about the basic concepts, right? So, to determine that what will be my taxable income, what will be the scope of my total income, whether the global income is taxable, whether the Indian income accruing or arising or received or deemed to be received is only taxable, right? For that purpose, you need to determine what is the residential status of the company. For the of determining the tax rate, what is the tax rate applicable to a company? You need to decide whether a company is a domestic company or a foreign company. Which company can be called as a domestic company?
Indian company and company which are giving dividend to its holders.
Correct. Very good.
Yes, it has been incorporated to make arrangements for declaration of dividend.
Correct. So, Indian company is a domestic company. That's fine. Secondly, a company which has made the prescribed arrangements for the declaration and payment of dividend in India. It can be a foreign company which is making the payment of dividend here in India. Declaring the dividend here in India can also be called as a domestic company. Fine. What is the tax rate for the domestic company?
Default regime means normal regime में 25 and 30%. And in new regime, it's depends upon which session, means 115 BAA or 115 BAB you have chosen. It's manufacturing companies, 115 BAB, which is 15%, and on 115 BAA, 22%. 10% surcharge is means mandatory level.
Correct. Yes.
Compulsory surcharge.
Correct. Very good. So the tax rate is 30, 25, depending on your turnover, right? Or otherwise what we have is two regimes. One, if you're a manufacturing company, 15. And if you are non-manufacturing company, if you want to exercise the option, then in that particular case, it is 22% plus 10% surcharge and then 6, right? So that is the tax rate. What is the tax rate for the foreign company students?
35%.
Sorry?
Now it is 35%,
35.
reduced rate of 35.
Correct. This is 35% now. So therefore, for the foreign company, 35, for the Indian company, for the domestic company, you have the 25, 30, 15 or 22, whatever you exercise. So you have to be careful when you write in the exam. You don't have to use the words Indian company or you don't have to use the words resident company. For tax rate, domestic company. For the scope of total income, resident company. So it is domestic and foreign for tax rate. For the scope of total income, resident and non-resident company. Are we clear? Now, when is a company resident in India?
If place of effective management is in India, then it
Place
is
of-
a resident in India.
Yes. So if it's an Indian company incorporated in India as per the Companies Act, right? Or it is a foreign company having the place of effective management in India. Are we getting this particular point? Now, coming to the point of what do we mean by the place of effective management in India? What do we understand by that? What is the meaning of place of effective management?
When board of more than 50% board of directors are appointed by this, and 4 tests we have to fulfill.
Ma'am, there are 4 conditions whether the company is engaged in active business outside India. There are 4 conditions to be satisfied.
Correct. But principally, the meaning of the poem is the place where the key management and commercial decisions are in substance made. The place where key management and the commercial decisions are in substance being made. Okay, so that is the place of my effective management. Now, this is a very subjective test, right? Because it depends on company to company where exactly the poem is. So CBDT has given a circular number 6 of 2017, which is giving the guidance for determining the place of effective management. So the first test is whether the company is engaged in active business outside India, which is called as ABOI test. Active business outside India test. There are 4 tests which are laid out. Now, theoretically, this is a word that you will have to remember, but this is not at all theoretical. What is the exact essence of this test? What is the exact purpose of bringing this word active business outside India? So first, let's understand. What do we mean by active business? What do we mean by active business?
Active business means the main activity, the ordinary activity where it is conducted, whether it is in a foreign country or in Indian country.
Correct. So active business means what? Whatever I'm doing routinely is the ordinary course of my business. Right? Like I'm into manufacturing, I'm into trading, I'm into retail sales. That is the active business. I'm a chartered accountant. My active business is providing the legal and tax services, providing the auditing services. That's the active business of mine, isn't it? That's the active business. Now you need to determine if my active business is outside India. Because it's a very subjective test, place of effective management, where the key management and commercial decisions are being in substance made. How will I identify? Such a subjective test, practically you will go and ask the companies that, you give us, like, where is your poem? How they even know where is the poem? You have to ask the questionnaire. You have to engage with the management through the interviews to come to a conclusion where is the poem. Right? Only in that case, there also you may not be able to fully come to a conclusion because what happens is, let's say for example, there is a big multinational company in US. 2 directors are sitting in India, 2 directors are sitting in Switzerland, 2 directors are sitting in US. It's so scattered, it's very decentralized. There are employees located everywhere. There is businesses in all these countries. Now the directors who are sitting in India also, whenever the board meetings happen, they may go to US. All the directors may go to US, but that's not feasible. The directors are people who are very, high net worth. They are highly skilled. They are people who are C-suite, as we call them, right? C-suite workers, where, they may be on the go. They may, sometimes take the board meetings on their travel. They may be visiting for the client meetings, let's say to Mauritius, let's say to Singapore, let's say to Dubai, and there they will just, conduct the board meeting for 1 hour in between there. So where is the place of effective management? They are not even taking the board meetings in India. Everything is online. They'll, come on Zoom, take the board meeting, decide something, and then that's done. How will it determine the poem? So that's the reason why the CBDT came up with this test to identify whether the company has the active business within India or active business outside India. If the company has the active business outside India, let's say we satisfy all the 4 tests and we say that the active business is outside India, then the CBDT says we will presume that your poem is outside India if the majority of your board meetings are also conducted outside India. So CBDT says that if your active business is outside India, if you're actively engaged in business outside India, then we will give a presumption in your favor to say that, okay, if your majority of the board meetings are held outside India, even if 1-2 meeting is held in India, that's fine. 10 meetings you are conducting during the year, out of which 8 are held outside India, 5 are held outside India, we will consider that this company is having the poem outside India. Unless we find out that the decision is not taken by the board members, but by some Indian resident or the Indian parent company. Quite possible. Board of directors, it's very easier for these companies these days to just, set up, some nominee directors. There are a lot of law firms in different countries which are giving these, services of nominee directors. They will give you board of directors for some charges. Now, these people are they may be just some graduates, undergraduates, whosoever, they may be just, put up on your board. They will not have any qualifications to undertake the business of the company. So, to just show that you have poem in different countries, what you will do, you will hire some directors in each country. And you'll say, no, my board is outside India. My board of meetings also happen outside India. And that's it. But in effect, it is you who is an Indian resident is taking all the decisions, or the Indian parent company is taking the decisions for the overseas subsidiary. So if it is found out that if the de facto decision making is happening in India by some Indian resident or Indian parent company, then we will revoke that presumption, because this is a substance over form test. We look at what is the substance, not just, what you're showing to us. What picture, what script you are writing doesn't matter. What actually you are doing, that is what is mattering. Are we getting this? And if you do not satisfy the ABOI test, if your active business is not outside India, then we'll ask you 2 questions. If your active business is outside India, we'll create a presumption in your favor that if you're holding more than, majority of your board meetings outside India, your poem is outside India, you're a non-resident company. Unless, we see that, okay, your board is not taking any decision, it is just, some sham board that you have created, but it is the Indian company or Indian resident who is taking the decision for that company. But if the ABOI test is not satisfied, we'll ask you two questions. Where are the key decisions being made? Where are you taking the decisions? And who is taking the decisions? So, when I say who is taking the decisions, whether it is a board of directors, whether it is some executive committee which is there, or senior management which is there, whether it's the shareholders who are taking the decisions. So we'll ask you those questions, and then basis that we'll say where are these decisions being taken. Right? And in that we'll see where is the location of the head office, whether if the meetings are conducted virtually. Then in that particular case, we'll see that, place where the directors are taking the decisions. So we'll ask you those questions only when your ABOI test is not satisfied. Fair enough? Up till now, are you clear?
Yes, ma'am.
Yes or no?
Yes, ma'am.
Yes? Okay. So now what do we mean by active business outside India test? Like, when do we say that the active business is outside India? So 4 tests that we were talking about. Whether the passive income is less than 50% of the total income. What is then the passive income?
Ma'am, passive royalty, interest, dividend, rental, capital gain, all these things we will call as a passive income.
Yes.
Also income from transaction where both sales and purchase is from the associate enterprises.
Correct. So passive income generally means other than the active income. If my active income is manufacturing, whatever else that I'm earning is passive income. Like, let's say, for example, if I say that, okay, I am into, auditing, that's my active income. The interest, the dividend that I earn from shares, the capital gain
So
that
the
I
passive
earn.
income is something like ancillary income. I mean,
Correct. That's a passive income. So whatever
Pardon?
other income which is not from my ordinary course of business is the
Yes,
passive
yes.
income.
Okay. Okay.
But they also say that if the purchase and sale is to and from A, because you may try to manipulate and say that no, I am into the active income, but you are purchasing from one associated enterprise, selling to another associated enterprise just to come out of this active business test. So in that particular case, they are adding this also. Where you're purchasing from unrelated parties, selling to A, that's fine. That would be your active, because you can't, manipulate the third party purchases. Or if you are selling to third party purchasing from A, that you can't manipulate. So you can't manipulate with the third person. You can manipulate within the group. So where only the sale and purchase is to and from A, that will also be considered as the passive income. Fine. Secondly, less than 50% of the assets are situated in India. Okay. Third is less than 50% of the employees are situated in India or are resident of India. Fourth, the payroll expenditure on such employees is less than 50% of the total payroll expenditure. Only when you satisfy all these 4 tests, it will be considered that the active business is outside India. Are we clear? Yes or no? So, if you have active business outside India, then as I said, you will be considered as, it will be presumed that your poem is outside India if majority of the board meetings are outside India. If not, we'll ask you 2 questions. Who are making the key decisions and where are those decisions, key decisions being made? Yes or no? Is this clear? Yes,
Yes, ma'am.
any
Clear,
question?
ma'am.
Okay. Now, I hope the screen is visible to all of you.
Yes, ma'am. Visible.
7. Okay. Let us solve a few questions here. Yeah. Example 1. Company A is a sourcing entity for an Indian multinational group incorporated in country X and is 100% subsidiary of B. The warehouses and stock in them are the only assets of the company and are located in country X. All the employees of the company are also in country X. Average income wise breakup is given for the 3 years period. 30% is from the purchases made from parties which are non-A and sold to A. 30% is made from A and sold to A. 30% is from the purchases made from A, sold to non-A, and 10% is by way of interest. So, how will you determine the poem?
This place of effective management is outside India because 30% is associated and sold to a associated, and 10% is other. Means passive income is 40%.
Correct. So, it is less than 50% of the total income?
Yes, ma'am. The passive income only the 40%, less than 50% criteria.
Correct. So in this case, our active business outside India test, because they are saying that even the assets are outside India, right? So in this
Right, ma'am.
particular case, the employees are outside India. So therefore, we will say that this is a company which is having the active business outside India. Fine. Let us take a next example then. The facts remain the same in example 1 with a variation that ACO has total of 50 employees. 47 managing the warehouse storekeeping accounts of the company are in X. The MD, CEO and sales head are resident in India. The total annual payroll expenditure of these 50 employees is 5 crores. And for the MD, CEO and sales head, it is 3 crores.
Ma'am, on the employee test, only 47% in outside India. On that payroll test, if you put 3 divided by, it's come more than 50 per 1 minute.
Yes. It is outside India or within India?
In India, ma'am, because 3 crore is paying to MD and CEO. So more than 50% payroll expenditures in India.
Correct. So here, even though less than 50% of employees are in India.
3.
Yeah. So even if the less than 50% of my employees are outside India, but the payroll expenditure in respect of the employees who are in India is more than 50%. So if all the 4 conditions are not satisfied, then in that particular case, the poem will be considered as within India.
Ma'am, cumulatively it has to be looked into, right?
Yes, that's right. So the ABOI test will not get satisfied.
If any one of the condition not satisfied, then the poem will be in India.
Correct. Poem will not be in India. We'll ask the 2 questions. Who is taking the key decisions and where are those being taken up?
Yes, ma'am. Finally, we will ask that question also.
Yes.
Ma'am, I would want to ask here in this example 2, the number of employees, it gets dissatisfied if you go by that, but the payroll expenditure gets satisfied. So, how do you draw conclusion on this? Can you explain it again? I mean, because you have to look at cumulatively it is getting satisfied or not. So, I want more clarity on this.
Correct. Sure. See, here what we are saying is, number 1, we are satisfying the test of the passive income less than 50% of my total income, right? We are having the assets also outside India, all the assets. So less than 50% of assets are in India. Less than 50% of employees are in India. 3 tests satisfied. Now coming to the 4th test. Less than 50% of the payroll expenditure on the employees which are resident or situated in India should be there out of the total payroll expenditure. That test is not satisfied because out of the 5 crore total payroll expense, 3 crore is for the MD, CEO and sales head. So the 4th test is not satisfied. If all the 4 tests are not satisfied, we will not say that the ABOI gets satisfied because the ABOI test fails. So only when you satisfy 1, 2, 3 for all tests, then only the ABOI is satisfied. Then only we say that there is active business outside India. If even one of the tests fails, then active business is not outside India. It is in India. And then we'll ask the 2 questions. Where is the key, who is taking the key decisions and where are those decisions being taken? Is it clear now?
Okay, fine. Yes.
Next one is the basic facts are same as in example 1. Further facts that all the directors of ACO are Indian residents. During the relevant previous year, 5 meetings of the board of the director is held, of which 2 were held in India and 3 outside India, with 2 in country X and 1 in country Y. They are not saying that facts are same as example 2, but the facts are same as example 1, where we said that the ABOI test is satisfied.
Ma'am, in this case, the poem will be in outside India because the majority, 5 out of 3 meeting held in outside India.
Yes.
Yes, ma'am. 60% outside.
Correct. Yes. So here in this particular case, since majority of the board meetings are conducted outside India, in that case, we will say that the poem is outside India. Because if the ABOI test is satisfied, then we just see that where are the majority of the board meetings conducted. If the majority of the board meetings are conducted outside India, here in this case, majority are, 60% are. So therefore, in that situation, we'll say that the poem is outside India. Are we clear? Yes or no? Okay.
Yes.
Okay. Next is example 4. It says the facts are same as in example 3, last example. But it is established that by the AO that the A company's senior management team signs all the contracts. For all the contracts above 10 lakh, that A must submit its recommendation to BCO and BCO makes a decision whether or not the contract may be accepted. It is also seen that during the previous year, more than 99% of the contracts are about 10 lakh. And over the past year, also the same trend in respect of value contributions of contract about 10 lakh is seen. So what will happen?
Means key managerial persons' decisions are taken in India, so he resident, ABOI test not pass means.
Correct. So if you look at it, here what they are trying to say is that even if majority of the board meetings are held outside India, but if it is seen that the directors are not exercising the control, but it is some Indian company or it is some Indian resident is exercising the control over the board, then we will say that the poem is not outside India but in India. So here if you look at the facts, it says that A company's senior management is signing all the contracts, but it has to take approval for all the majority of the contracts that are there, which are usually, over about 10 lakhs only. So in majority of the contract, 99% of the contract, it has to take the approval from the BCO before entering into any contract. That shows that the BCO is exercising the control over ACO's board and it is not ACO working independently. So even if the majority of the board meetings are outside India, ABOI is satisfied, we will say that the poem is in India. Because in substance, the decisions are being taken by the Indian Investment Company. Are we clear? Yes or no? Any questions? Any doubt? Fine? Yes. Any questions?
No, ma'am. Clear, ma'am.
Clear, everybody? Yes, if you have any questions, please feel free to ask me. Okay. Now, if let's say the player management is outside India or within India, now when you are determining that, there are certain points that you have to remember. Let me share the screen once again.
Ma'am, so in the last example, the strong reasoning for the answer is, may I know what is that? I mean, the final answer is it is resident in India.
Correct. It's resident in India.
Okay, so strong reasoning for it is because if you go by the example, I find it a bit different than the rest that it is usually asked. I mean, you are consulting another company for, recommendations and all of it. So, can you explain what is the strong reasoning behind it to get into this conclusion?
Sure. See, in this particular example that we discussed, so ACO has to take the approval of BCO for all the contracts that it is making. See, if it would have been, let's say, for more than rupees 10 lakh contract, what they have said ki only when my contract value is more than 10 lakh, only then I have to obtain the approval of BCO. But they are saying that 99% of my contracts are more than 10 lakh. And this trend has been seen in all the years. So, meaning I independently can't enter into a contract as a company. I have to take the approval from my board. From the BCO. So, if
BCO,
BCO
okay.
is without BCO's permission, I cannot enter into contract. I cannot independently carry out my business. That means BCO is exercising the control over my company. And it's not my board of, usually, these are decided by the board of directors. So if the board of
Yes.
directors are also subsumed or the BCO has the power and the board is just there, for artificial purposes, then in that particular case, it is, effective management is with BCO and not ACO. And that's the reason why they say that in this case, the poem will be considered in India. Are we clear?
Okay. Yes, yes. Understood.
Fine.
Thanks.
So see, whenever the questions are asked on the poem, it can be a case study scenario question itself, case scenario, where they'll give just one of the point, it can be MCQ based. So you have to read the facts carefully. Also, it is not always the case that just because the foreign company is owned or wholly owned by an Indian company, poem will be in India. No, it needs to be ascertained whether the Indian company is exercising the control over the decision making of the foreign company. Only then you can say that poem is in India. So you have to examine each case independently. It doesn't mean that, if one of the director or some of the directors are Indian resident of a foreign company, poem is in India. No. So each case has to be examined in a light of the facts and circumstances of each case. It doesn't mean that if the foreign company has a branch in India, some office in India, poem is in India. That's not the case. Some local management is there in India. That is fine. The local management can be there. But who is taking the key management and commercial decision? What do we mean by key management and commercial decision? Whether I should, start a new business. So whether I should, have, let's say 10 employees, 15 employees, or I should, retrench some employees. Whether I need to discontinue this line of business, whether I have to start the business in, let's say, Singapore. These are the key management and commercial decisions. Not like, how much, I have to pay you, daily accounting to whom I have to give, which firm I have to select for auditing. These are routine decisions that may be taken up by the local management in India. These are not key management and commercial decisions. Who is going to audit your books of account? Is it a key management and commercial decision? No. They may have some local management in India who may be taking some routine day-to-day decisions. They may have some powers with respect to deciding hiring some employees in India, hiring some consultancy firms in India. That's fine. But the key decisions, let's say, for example, if you talk about the cars, okay, so let's say you keep on seeing that, let's say this Hyundai has come up with some new car. So this is not decided by local management. When this is to launch, in which markets we will launch this, what kind of car are we going to launch, what is the pricing of that car we are going to keep. That is the key management and commercial decision. So now let's say the sales happen in India and the local management is involved in undertaking that sale. That is not key management and commercial decision. The key management and commercial decision is what to produce, when to produce, how, which markets, pricing, all of that is the key decisions. Who is taking those decisions and where are those decisions being taken? That is the answer to where is the poem. Are we clear? Yes or no?
Yes, ma'am.
Okay. So once you have the place of effective management in India, there are these transitional provisions which are applicable. What do we mean by transitional provision? Because first time you become a resident of India as a foreign company, so now obviously you will be assessed more or less like the Indian company only. You will be allowed the depreciation, you will be allowed the set off and carry forward of losses, right? You will have to now prepare the books of accounts, profit and loss account, balance sheet as per the Indian accounting principles, isn't it? Or for the tax purpose also. So for all that provisions, the transitional provisions are introduced under section 115JH, chapter 12 BC. First is, how do you determine the WDV of the asset? Because now you will claim depreciation. It's not a new asset that you have purchased this year. You may have the asset since many years. So how do I arrive at WDV? I can't give you the depreciation basis on what you are claiming in the other country. Can I? Answer is no. For the income tax purposes, the rates are there. The way of WDV is there. Right? So how do I give you the depreciation? What will be my, should I take the actual cost? The answer is no, because this asset is the old asset. It's not the new asset. How can I give you the actual cost? So therefore it says if the foreign company is assessed to tax in the other country, in the foreign country, then we will start with the WDV as per their tax return. If the WDV for some reason is not available as per tax return, then we will arrive at WDV by calculating the notional depreciation on the actual cost since the year it was first bought. We will arrive at notional WDV at this point. And if let's say I was not accessible to tax in the other country, then I will take the WDV as per the books of accounts. Clear? If for the purpose of my maintaining the balance sheet and the P&L, so it has to maintain the balance sheet and the P&L from the period of accounting year start to 31st March of the preceding year. Right? Now, it is possible that I may have the accounting year different than the previous year in India. In India, we follow April to March. There, they follow July to June. They have like from March to April. You have from February to, January. They have calendar year. They have different years in different country. How do we do that? So what the 115GH says is that if the accounting period you have to prepare is from their accounting year to our 31st March of the last year and 1st April to 31st March of the year in which you have the poem, right? So if the period from your accounting year, when it starts up till 31st March, let's say your accounting year is a calendar year, right? So you will prepare from 1st January 2024 to 31st March 2024 and then from 1st April 24 to 31st March 25. Now, since the period between your accounting year and the 31st March 2024 is less than 6 months, then we will make a combined balance sheet P&L of the two period from 1st January 2024 to 31st March 2025. Because we can't prepare a balance sheet P&L for only 3 months, right? If it is more than 6 months, let's say I follow July to June. So I have to prepare from July 23 to March 24. Now it is more than 6 months. So I'll prepare the separate balance sheet P&L. So July 23 to March 24, one balance sheet P&L. From April 24 to March 25, another balance sheet P&L. Clear? Now, if I have the brought forward business loss and the unabsorbed depreciation, you will allow me because now my global income is taxable. So you will even allow me the business loss and UAD. But what will be my brought forward business loss? So if I am assessed to tax in the other country, as per the tax return, whatever the loss is there in that tax return, I will allow you this loss in India. If I am not assessed to tax return, then the business loss and UAD as per my books of accounts. Now this business loss and the UAD though is like carried forward and set off for unlimited years, but for the business loss, I will allow for the remaining period of 8 years. Let's say you incurred the loss and 3 years have already passed by. So balance for 5 years, you can claim the carry forward and set off of the loss. Are we clear? It's not that you will get the 8 years from the year in which you became resident. You will get for the balance period only. So total 8 years you will get as you get it in India. Clear? But there is a catch over here. See, this business loss or the unabsorbed depreciation is incurred in the foreign country. Yes or no?
Yes, ma'am.
It's not Indian loss. This is the foreign business loss, which has been incurred in the past years, and now you're trying to set it off against your current year income. So what the law says is, if you look at this, if this loss which is there, we will only allow the set off of this loss against the income which we are taxing here in India because you have now the poem in India. Meaning, let's say if a foreign company is there, which has, let's say, a branch in India, or let's say it has some royalty income in India. Now, this income is arising in India or deemed to accrue or arise in India. Whatever Indian income is there, that is any which way is deemed to accrue or arise in India, right? So that will be taxable even if there is no poem in India, right? If a foreign company has a branch in India or dividend or interest or royalty, whatever it is there, you'll be able to tax it in India. Yes or no? Even if there is no poem. Correct?
Yes, ma'am. True.
Yes.
Correct? True? Now, let's say for example, I say that you have a poem in India. So what additionally you will tax? Whatever my US income is there. Correct? Fine. So now this brought forward, let's say business loss of US is there of rupees, let's say 5 crore. This I can only set off against the income which is getting taxed in India because there is a poem in India. So basically I can set it off only against this foreign income of 4 crore. I cannot set off against this Indian income of 6 crore. So only 4 crore I will set off, 1 crore I will carry forward for the remaining period. Why? Because this Indian income was any which way taxable irrespective you had a poem in India or not. So now when you are saying that the losses that you have incurred in the other country, you want to set it off against this Indian income, that's not possible. That's a loss to government. We will not allow that. You can only set off against the foreign income only, which is now getting taxed in India because you have poem. This loss was never Indian loss. This is the foreign loss. So you set off against the foreign income. And balance, if any, you can get what pay the tax in India. Don't claim the set off of that loss against my Indian income. That's what the government is saying. Are we clear about this?
Yes, ma'am.
Yes,
Yes or
ma'am.
no?
Clear.
Anybody has not understood this point? All of you clear? Fine? Okay. Next is the TDS. The TDS, if you become a company which is now a resident in India because you have the poem in India, right? The TDS will not be applicable under 194C, 194J, 194I. No. The TDS will continue to be applicable under 195. So when any person makes the payment to such a foreign company which is now a resident in India, they will not deduct TDS under 194CJ. They will deduct under 195. Why? Because if you read the wording of 195, it's only when it is an Indian company or a company which has made the arrangements for declaration of dividend in India. You are a foreign company which is a resident in India because of having the place of effective management in India. So what will be your tax rate?
35%.
35%.
5%, because you are not a domestic company. The 22, 25, 30 is or 15 is applicable to a domestic company, not to a resident company. Now, did you understand the distinction correctly? Yes? So,
Yes, ma'am.
even when you become the resident in India, the tax rate will be applicable of 35%. Are we clear, students? Yes or no? Yes? Any questions? Any doubt? Yes, please. Okay? Fine. So this is about the residential status which is there. Right? This is about the residential status of the individual, firm, AOP, BOI, HUF and the company. So let's take a break over here. We get back in 10 minutes and then we will start with the taxation of the non-resident. Fine? Let's take a break of 10 minutes.
Yes, ma'am.
Yeah. taxation now. So for a non-resident, what is the income which is taxable in India? As I told you, income received, deemed to be received, income accruing, arising, or deemed to accrue or arise in India, right? Received is, whenever it is received in your bank account, right? Accruing, arising means that whenever the income has some, connection, some source here, it is income accruing in India. Now, what do we mean by deemed to accrue or arise in India? So section 9 talks about it. Section 911 says all income accruing or arising, whether directly or indirectly, through or from the business connection in India. What do we understand by the term business connection? Yes, can anybody explain me what is the business connection? Yes.
One is 3 lakhs and more participants through this internet.
No, that is for significant economic presence. No.
Yes,
See,
yes, yes.
business connection means what, students? I'll explain. See, uh, whenever there's a foreign company, okay? Now, foreign companies' income, which is a non-resident, right, will be taxable in India only when it has some sort of connection with India, right? India cannot tomorrow say ki bhai, I'll tax your income. That's not going to happen. India can only have the jurisdiction to tax, it can have the power to tax only when the India has some linkage with that income. Can India tomorrow say that there is a person who is, working, doing business in US, I'll tax his income? No, it can't. It doesn't have the jurisdiction. That will be extraterritorial. Can US tell you that tomorrow your articleship income that you are earning, whatever, like stipend that you may be earning, can US say we'll tax it? Answer is no. It doesn't have any connect with you. There has to be some amount of connection. Either you can be, resident of US, or you're receiving in US bank account, or it is that you are doing articleship in US. Right? Either of these three scenarios US can tax. Same goes for India. So what is business connection? Business connection. Doing business in India, right? That is what is meant by business connection. It's not defined. It just means simply that I am doing an organized business activity in India from which I am earning the income. So there is a connection between the business activities and the income from that business. So I should be carrying out the organized, routinely the business activities in India, and I should be generating the income from that. I should be doing the business in India to earn that income. Yes or no? That is the meaning of the term business connection. So, if the income is accruing or arising either directly, indirectly, through or from any business connection in India, it will be said to be deemed to accrue or arise in India. Now, explanation 2 to section 911 says, business connection shall include not only when you do the activities yourself, but even when your business activities are carried out by a dependent agent. Who is a dependent agent? Who is working for you and who has the authority to conclude the contracts on your behalf. Who has the authority to conclude the contracts on your behalf, or who plays a principal role. He's not having the authority to conclude the contracts, but he's playing a principal role leading to the conclusion of contracts in India. Are we getting this point? So who has the authority to conclude the contracts or habitually concludes the contracts or plays a principal role leading to the conclusion of contract. Example, let's say there is a US company, right? Now it has hired me to do the business activities here in India. I am its agent, right? Now what I will do is I will identify the customers. I will, discuss the products that the company is offering, right? And will sell those products. And I will, negotiate the pricing. The customer may say, no, this 100 rupees is, too much. We are only able to pay 80. Okay, you pay 80. Let's close the deal. And I will conclude the contract. I will be considered as constituting the business connection for the non-resident. Isn't it? So basically, I am constituting the business connection for a non-resident. Business connection is what? It is just that, you are carrying out the activities either you yourself or through an agent. Right? And that itself results that, okay, there is some sort of nexus, there is some sort of connection with India, and India will get the right to tax. There is source of income in India. Are we getting this point? So let's say, for example, you may say that no, our agent doesn't have any authority to conclude the contract. Fine. If the agent doesn't have authority, but he's doing everything else, he's negotiating, he's identifying the customer, he's deciding the prices. It's just that he's not, just formally signing the contract. It doesn't mean that there is no business connection in India. There is still business connection in India because your agent is doing all the activities for you. It's just that the contracts you are only concluding. It will still result in the business connection. Agent doesn't conclude the contracts or doesn't play a role in concluding the contract, but is maintaining the stock of goods habitually from which he is regularly delivering the goods. Still there is a business connection. Or he is habitually securing the orders for you. There is a business connection. Are we clear? But if he is an independent agent, meaning he is not working only for, one non-resident, he is working for multiple non-resident, he's, independent enough to decide, which products he want to stock. He is working for multiple non-residents. He's not under the directions and control of that one non-resident. He's an independent agent. He's working for himself. He's not working for one principal. So that will not result in business connection because he's working for himself. He's not working for me. It cannot be said that, I am doing the business activity through an agent because that agent is working for himself. He's not working for me. He's not under my directions and control. That will not constitute the business connection. Are we clear about this? Yes or no? Yes, students? Yes, are all of you tired? I'm not getting the yes.
No, ma'am. Can you explain it again?
Sure, I will. So, as I said, that, that if, let's say, for example, the business connection will mean that I am doing the organized business activity in India. Let's say, for example, I am a car manufacturer. Now, if I am selling the cars in India, let's say one of, like this Rolls Royce is being exported, or, like these some fancy cars you see that, big businessmen import here in India. Will it constitute business connection? Yes or no? Yes.
Yes. Import
Will it?
item.
Sorry?
This is importation, no?
Yeah.
Business connection is connected. I don't know.
See, one of an activity is not business connection. Business connection means what? That there has to be some sort of organized activity of doing the business. Right? Like, let's say, for example, if some businessman today imports some car which is not available in India, that will not result in business connection. Because that company is not even advertising in India, that company is not even having any office in India, any sales center in India, any service center in India, nothing. there is no business that the company is doing. Just it is exporting one car, or maybe let's say 10 cars in a year in India. There is no business connection in India. Versus, let's talk about a company, let's say like Hyundai. Hyundai has the office in India, from where it is doing marketing, where it is doing the sales, where it is having the employees, where it is doing everything in relation to generating the business in India. And it earns income from that sale of car. In that case, there is a business connection, because business connection means that you are doing some organized business activity on a regular basis and not a one-off transaction. That's what you have even learned in the PGVP. What is business? Business means that you are doing a regular, routine, organized activity of undertaking the operations. So business connection means that there has to be the connection between the business income that you are earning and the activities that you are carrying out in India. You have business connection in India. Connection means from the activities of the business that you are carrying out. If you are only exporting 10 cars during the year without having any office, without having any presence, without marketing, without sales, without support, there is no business connection absolutely. Now you can carry out these activities yourself, or you can carry out through an agent. Right? If he's a dependent agent, he's working under your directions and control. That will constitute the business connection. Right? So who is considered as a dependent agent? One who is concluding the contracts on my behalf. Or if he is not concluding, he is doing everything else leading to the conclusion of contract. He is negotiating, he is deciding the price, he is, identifying the customer, he is doing marketing, he is doing everything else, but he is not just concluding the contract. But he is doing everything else to go towards the way that is leading to conclusion of contract. He is a dependent agent. Who is maintaining the stock of goods from which he is making the sales? Who is securing the orders for me? All these conditions, when it is satisfied, he is a dependent agent. If a person is acting in the ordinary course of business, he is working for himself, he is not under my direction and control. Even if then he does the sales for me, secures the order for me, he will be considered as an independent agent if he is not under my control. If he is not only working for me. Are we clear about this now?
Yes, ma'am. Yes, ma'am.
Okay, everybody clear? Yes? Okay. Now?
Yes, ma'am.
Significant economic presence also is considered to constitute the business connection. Now, what does this mean? So, let's say, for example, when I'm talking about the business connection, what I tried to say is that there has to be some amount of organized activity being carried out in India, and you are generating the income therefrom. That is business connection. So, what I'm reflecting on is that we should have some amount of physical activities being carried out in India to earn the business income. Correct? Now, in the world that we are living in, well, it is quite possible, 5 years back, we didn't have these kind of classes, right? Where, you were learning from your home, right? Where you were doing everything. You had to go to the ICAI branches to get the training. The faculties had to come there. Today, we are living in a world where I don't know most of you where you are located. You may be located, in multiple different cities. And still we are able to, have that kind of presence. So today, it's more than that is possible in today's age, right? Where the businesses can be carried out virtually. You can order now everything at the click of your mobile phones. Right? We have 10-minute delivery apps. We have everything else, right? So it is no more required that, you should have a business activity in a particular country. Earlier, when you had to take the lectures, I had to come to branch. I had to, like had the branch office premise available till let's say 9. There will be person sitting over there who will be helping me to conduct my lecture with ease. You had to come. There were chairs, furnitures, whatever, benches, everything was there. Today, is it required? What is all required is just this Zoom platform, isn't it? Everything is digital. Same goes with you can order today from the foreign company's website on online directly. Just you go onto the website, put your login, and the goods will get delivered to you. 5 years back, we had this something called as AliExpress, Alibaba, right? Where you were, able to import the goods from China over here. Isn't it? So, did
Yes.
Alibaba, AliExpress had these offices here in India? Absolutely not. They were shipping from China here. And there was this one website, which most of you girls might be using. It's Shein. Now it's not there. So again, Shein did not ever had any presence here in India. They did not carry out any activities in India. So what was happening? There was no business connection. But we were still able to online, do the buy the things from Shein, buy the things from Alibaba Express. So how was it even possible? So in that particular case, it was all through their website. So though they were generating enormous sales in India, but they did not carry out any business activities in India, and because of which they never had any business connection in India. And that is the reason why this particular provision was introduced, which is significant economic presence. What does it say? That SCP will now constitute the business connection. What is SCP? If there is any transaction in respect of goods, services, property carried out by a non-resident with any person in India, any transaction, it can be marketing, it can be sales, it can be payment, whatever in respect of goods, service, property, which is carried out by a non-resident with any person in India, including the download of data or software, if the payment is more than 2 crores, it will constitute the SCP, and SCP is going to constitute the business connection. Or systematic and continuous soliciting of business activity or engaging in interaction with the users in India. If there are more than 3 lakh users, for example, Instagram, right? It is interacting with users. Instagram will have SCP in India. Facebook will have SCP in India. WhatsApp will have SCP in India. Google will have SCP in India. Because it is interacting with more than 3 lakh users. Yes or no? So therefore, even if you do not have any business activities, you do not have business connection directly, but if you have these criteria satisfied, you will have SCP, and SCP will result in the business connection in India. Are we clear about this? Yes or no? Yes?
Yes. Yes.
Okay. So again, this can be asked as a part of the, smaller questions in the examination in the form of like, case scenario questions where you will have to answer this accordingly. Fine. Next one is income accruing or arising directly or indirectly through or from a property in India. If you are generating rental income from property, that will be income accruing or arising from the property in India. That will be deemed to accrue or arise in India. Income accruing or arising from the asset or source of income in India. If you have interest income, if you have dividends, whatever it is, if you have any income from any asset in India, that is income accruing or arising in India. Income accruing or arising directly or indirectly through or from the transfer of capital assets situated in India. If you are transferring any capital asset, there is a capital gain that will be considered as income deemed to accrue or arise in India. Clear? Now coming to this income through the transfer of capital assets situated in India. So let's say for example, if there is a company A, which is a resident of UK, it has a subsidiary company B, which is a resident of Mauritius. And that has a company C, which is resident of India, another subsidiary. Fine. Now if you look at The balance sheet of company B, which is resident of Mauritius. This has the share capital, which is nothing but held by A because this is a subsidiary of A, right? And this has the investment in company C, which is its subsidiary. Yes or no? Right? Company B ka balance sheet will look like this only, isn't it? It will have share capital held by A and investment in company C. Yes or no? Yes? Yes, please. Yes? Okay. Now, let's say, for example, if the company A wants to sell the business here in India, what it will do? It can sell the shares of company C. Correct? It can sell the shares of company C. If it sells the shares of company C, what will happen? What will happen to the capital gain? Yes.
Taxable in India, no?
Correct. Deemed to accrue or arise in India, income from the transfer of a capital asset situated in India is deemed to accrue or arise in India. Clear? Now, then it will have to pay tax in India. Correct? Now, in order to avoid the tax in India, what company A will do, instead of selling the business of company C or shares of company C, it will sell the shares of company B. Because company B is not having any other business. It is just holding the investment in company C. Correct? So indirectly, what will happen if company B gets sold off? Automatically, the underlying company will also get transferred. Yes or no?
Yes, ma'am.
That way, it will not be taxable in India. Why? Because company B's shares are not situated in India. Company B's shares are situated where? Mauritius, where the company is incorporated. Correct? Shares are situated where the company is incorporated. Yes or no? Fine. So, it will avoid the tax in India. But the Indian government says, no, will not let this happen. Since the company B's shares are deriving the value from the Indian asset, the shares of company B will be deemed to be situated in India. How come? See, if the business in India grows, what will happen? Value of the will grow. Performing well, its business is growing. What do you see in the stock market? Shares of Reliance go up. Yes or no? Correct? So now, if the shares of Reliance or company C are growing, what will happen? Automatically, company B's shares will also grow up because its investment, the market value of its investment will go high and high. Correct? So this side also will go high and high. Yes or no?
Yes, ma'am.
So company B's shares are deriving the value from company C's shares because company B के पास है ही क्या? Only investment in company C. Correct? So, the Indian government says that the shares of company B shall be deemed to be situated in India if the share of company B derives the value substantially from the assets located in India. Now, if the shares of company B are deemed to be situated in India, what will happen? Any capital gain on the transfer of company B shares shall be deemed to accrue or arise in India. Correct? Yes or no?
Yes, yes.
Fine. Now, how do we identify? This is known as indirect transfer. So, first you have to identify the specified date for determining on which date you will consider the market value of the shares. See, to identify whether the shares of company B derive the value from company C, you have to identify the market value of company C. Correct? So, on which date market value you will take? Whether on the day when you are transferring the shares of company B or as on the last day of the accounting year. So the Act says to identify the date on which the FMV has to be taken, you need to see whether the book value of the assets of company B as on the date of transfer are greater than 15% are greater than by 15% of the book value of the assets of the company B on the accounting year end. So you compare the book value of all the assets of company B, okay, as on the date of transfer, and see whether they exceed by 15% or from the book value of the assets of the company B as on the accounting year end date. If the answer is yes, you take the FMV as on the date of transfer. If the answer is no, you take the FMV as on the date of the accounting year end. Clear? Now, to determine if the shares of FCO derive the value from the Indian assets, the FMV of the Indian assets should be more than 10 crores. FMV of companies B shares, FMV of the company C shares should be more than 10 crore. Plus the FMV of the company's B share should be greater than 50% of the FMV of the total assets of the company B. Are you getting this particular point? So if I am saying here that, what do I have to check? That whether the FMV of the company C, the shares of company C should be more than 10 crores, plus the shares of the company C's FMV should be more than 50% of the total FMV of all assets of company B. If the answer is yes, then we can say that the shares of company B are deriving the value substantially from India and they will be deemed to be situated in India. And then the capital gain on transfer of the B's shares will be deemed to accrue or arise in India. So to determine on what date we have to take FMV, you have to compare the book value of the company B's shares, book value of the company B asset. Book value as on the last day of accounting year versus the book value as on the date of transfer. Whether it exceeds by 15%, you take the date of transfer. If no, you take the accounting year end date. Are we clear? Yes or no?
Yes, ma'am. This means company A is of UK is 100% holding is compulsory, ma'am, for both the companies. So
No, it is not compulsory. What you have to see is that whether the FMV exceeds 50% of the total FMV of all assets. This needs to be seen.
Both the condition we have to satisfy. This 10 crores and 50% of this.
Right. Yes. Fine. Now, just because the shares of the company B are deemed to be situated in India, the CBDT has clarified that whatever dividend is declared by company B, that will not be said to be deemed to accrue or arise in India. Because, when you are declaring the dividend is the income accruing on the shares. If the shares are deemed to be situated in India, the shareholders had the apprehension that even dividend will now be deemed to accrue or arise in India. So CBDT clarified no. Only the capital gain will be deemed to accrue or arise in India. Dividend will not be deemed to accrue or arise in India. Fine. So that is about the indirect transfer. Also, there's one exception that the indirect transfer provisions are not applicable if the right of management and control are not transferred and the transferor has less than 5% shareholding in foreign company. So basically these provisions will not get attracted if less than 5% is there in the foreign company. Let's say, for example, if company A is holding less than 5% in company B, there will not be any indirect transfer provisions attracted in that case. Or if company A is not having any management or control rights. Fine. In those cases, indirect transfer will not get attracted. Because capital gain will be taxable in the hands of company A only, right? It is the seller. Seller is company A. So this capital gain will not be taxable if company A is holding less than 5% and it does not have any management or control rights. Clear? Any questions? Any doubt? Yes? Fine? Okay. The next provision is section 912. What is it? 912 is salary. So when is the salary income set to be deemed to accrue or arise in India? Salary income is set to be deemed to accrue or arise in India when the services are rendered in India by a non-resident employee. Right? So let's say, for example, I'm working for a foreign company and I'm also a non-resident. Can India tax my salary?
Yes, ma'am.
Yes.
If you are doing services in India, then your
Then only you
salary.
can tax. Yes. So meaning thereby, I should be rendering the service in India. I should be performing my activities here in India. Only then can India tax, not otherwise, right? If I'm not coming to India, I'm not rendering services in India, India cannot tax. So basically, the salary will be deemed to accrue or arise in India when the services are rendered in India and the salary gets earned in India, right? So therefore, in that case only, the salary will be deemed to accrue or arise in India for a non-resident. If I'm working for a government, if I'm working for the government of India, they say that the salary will be deemed to accrue or arise in India if I am a citizen of India in respect of the services rendered outside India. The salary shall be deemed to accrue or arise in India. So if I'm working for government of India and I'm an Indian citizen, let's say I'm working in Indian embassy in, let's say, London. My salary income, even if the services are rendered outside India, I will still be liable to pay tax in India because the salary will be deemed to accrue or arise in India. However, any allowances or perquisites which are given by the government will be exempt, irrespective of whether I go for 115 BAC or I go for the normal regime. Are we clear?
Yes, ma'am.
Sorry, there was some disruption in the network. Yeah. So basically, if any allowances are given, that shall not be taxable. That will be exempt irrespective of the tax regime. Right? Any remuneration to a person who is not citizen of India by a foreign embassy, that shall be exempt. So let's say, for example, I'm not a citizen of India, I'm working for German embassy. So any salary which is there, even if it is accruing or arising in India, deemed to accrue or arise in India because the services are rendered in India, but this is specifically exempt. Clear? Or any remuneration to a foreign national by a foreign company for services rendered in India will be exempt subject to these conditions. If the foreign company is not engaged in any trade or business in India, stay of employees less than 90 days, and remuneration is not claimed as a deductible expense in the income chargeable to tax in the hands of the foreign company, then it will remain exempt. Are we clear? Yes, students, is the salary portion clear?
Yes, ma'am.
Fine. Next is section 914, which is in respect of dividend. It says dividend paid by an Indian company, even if it is paid outside India in your foreign bank account, it shall be deemed to accrue or arise in India. Fine. Now the tax rate in case of dividend is 20% under 115A, right? So as I was telling you, there are differences in the rates of the resident versus a non-resident. For a non-resident, the tax rate is 20% under 115A for dividend. If it is paid by IFSC unit, it is 10%. And if it is paid by a business trust, where the SPV is exercising the option under 115BAA, it is 10%. If the SPV is not exercising the option under 115BAA, it is exempt. Remember this? Fine. Then is 914, 915, 916 we'll do all together, which is interest, royalties and fees for technical services. So the source rule for all of this is same. It is dependent on the payer. Where is the payer? So if for the interest, royalty and FTS, the payer is the government of India, interest, royalty, FTS shall be deemed to accrue or arise in India. Are we clear? If the payer is the resident of India, interest, royalty, FTS shall be deemed to accrue or arise in India. But there is an exception. If the interest, royalty, FTS is for the business or profession carried on outside India or for making or earning any income from source outside India, in that case, it will not be deemed to accrue or arise in India. What do we mean by that? So let's say, for example, if there is a resident who is making the payment of interest on loan taken from non-resident, will this be accruing or arising in India or deemed to accrue or arise in India? Yes?
Yes, ma'am. Interest is given by Indian person.
Correct. Interest is paid by Indian person, Indian resident, so it will be deemed to accrue or arise in India. But if this loan is utilized by Mr. A for the purpose of doing the business in US, in that case, interest shall not be deemed to accrue or arise in India because this is for the business in India. Let's say I am taking loan from Bank of America for starting my CA firm in US. Will this interest that I will pay be accruing or arising in India?
No, ma'am.
No, right? Because this is for the business or profession carried on outside India. Clear? Now, interest which is paid by a non-resident, it can also be deemed to accrue or arise in India. Let's say I am a non-resident. I am making the payment of interest on loan taken from Citibank or Bank of America, US. This can also be deemed to accrue or arise in India if I'm taking this loan for the purposes of my business in India. I'm a non-resident. I'm taking the loan from a foreign bank for the purpose of starting the business in India. The interest that I will pay will be deemed to accrue or arise in India. Are we clear? And the same goes for the royalties and for the FTS as well. Are we clear about this point? Yes or no? Clear? Yes, students.
Yes, ma'am.
Fine. Now, the tax rate for the interest which is there is 20%. It is 20% as the residual rate. If it is on infra debt fund, it is 5%. If it is on the rupee denominated bond listed in IFSC, it is 9%. If it is from the business trust on interest received from the SPV, it is 5% under 194 LBA. Are we clear? But the general tax rate is 20%. Clear? Yes or no? Now coming to the fees for technical service. What is the meaning of fees for technical service? Yes. What is the meaning of fees for technical service, students? What do you understand by FTS? Yes, please. So FTS means technical, consultancy, managerial, professional, these kind of services, right?
Specialized services.
Correct. Specialized services which are in the nature of professional, technical, consultancy services, right? That's the FTS, right? So if you are providing any kind of technical service, if you are consulting, if you are, providing some professional services, doctors, CAs, lawyers, whatever are providing services, those are FTS, right? So these kind of services will be the deemed to accrue or arise in India on the same basis what we studied for the interest depending on the payer. But as far as the tax rate is concerned, what they say is if if the non-resident does not have a permanent establishment in India, if a non-resident does not have a permanent establishment in India, permanent establishment means any branch or office in India, it will be taxable under 115A at the rate of 20% on the gross basis. Gross basis meaning you will not get any deduction of expenditure against that. It will be flat taxed at 20%. Plus, you will not be required to file the return of income if your TDS is deducted under 195 and your only income is interest, royalty, dividend or FTS. But if a non-resident has a branch, office, permanent establishment in India, then it will be taxable on the net basis meaning the income, the revenue minus the expenditure at the rate which is applicable to the foreign company. What is the rate applicable to foreign company? 35%. Are we clear? So you will get the deduction of expenditure. If you have a branch or office in India, you will get the deduction of expenditure, which is in respect of that P. So what expenditure you will get is expenditure which you have incurred for that P, wholly and exclusively only for P. Any kind of expenditure which is not incurred wholly and exclusively for P, any expenditure for the head office, those expenditure will not be allowed as the deduction. Are we clear? Yes or no? Any questions, any doubt? Yes? Is it clear?
Yes, ma'am.
Fine. So this is again very important that you have to remember in respect of the FTS and interest. Now coming to the royalty as well. But you need to remember that what are these tax rates, right? These can be asked as a question. Now coming to the royalty, I'll take you through from the module. What is the meaning of royalty? So royalty means consideration, including any lump sum consideration, but excluding any consideration which is income of the recipient under the head capital gain. So basically royalty means consideration for the transfer of all or any rights, including the granting of a license in respect of patent, invention, model, design, secret formula, process or trademark or similar property. What does this mean? So if I am transferring any right in respect of any kind of these intangibles, that shall mean that I am making the payment for royalty. Let us take an example. Let's say I am giving you the trademark to use my firm's name, right? Now the payment that you will make to me is nothing but the royalty. Clear? Next is imparting of any information concerning the working of or the use of a patent, invention, model, design, secret, formula, process, trademark or similar property. So, any information that I am imparting to you as to how to use this, let's say, formula that I have developed, or how to use this, patents that I have registered. Let's say, for example, I have developed a medicine. Now, this medicine which is there, or this kind of, let's say, some innovative formula that I have developed for some chemical that I have developed to cure some disease. Now, you can put that chemical in your own already, tablets that you have, and you can sell those. So I will give you the information as to how do you use that tablet or how do you use that chemical in your tablets. So the payment that you will make to me for that information will be royalties. Are we getting this point? Then the use of any patent, invention, model, design, secret, formula, process or trademark or similar property. If I am allowing you to use my name, I'm not granting you the right in respect of my patent. I'm not giving you the right to get my patent now or get my first one was transfer of any rights. I'm not transferring you the rights. You don't have right to modify. You don't have any right in that. I'm just allowing you to use my patent or use my design. And the payment that you make for it is nothing but royalty. Imparting of any information concerning technical, industrial, commercial or scientific knowledge, experience or skill. So if you are imparting I'm imparting you any technical information, I'm giving you any scientific knowledge, the payment that you make to me is royalty. Right or use or right to use any industrial, commercial or scientific equipment. This is very simple. If I'm giving you some equipment to use, that is royalty. Transfer of rights in respect of copyright, literary, artistic, scientific work, including films or videotapes, is nothing but the royalty. So let's say I'm giving you a computer software, right? And you can use that code which I've developed in the computer software and make a further production out of that. The payment that you will make to me is royalty. But when you make the payment to me for just using, let's say, Microsoft Office, Tally, whether that is royalty? Answer is no. The Supreme Court has said that in case you are coming from a country with which India has a tax treaty, and in that tax treaty, computer software is not specifically included in royalty, it will not, the payment for the purchase of computer software is not royalty. Because what you are getting by getting the license to use MS Office Tally is the copyrighted product and not the copyright in the software. You don't have right to alter that code. Are you getting that point? So that is not royalty. But as far as if you're not coming from a country with which India has a DTL, then in that particular case, the Income Tax Act says that the consideration for the use or right to use a computer software is going to be royalty. So only when you have if you are coming from a country with which India has a treaty, in that case, you can claim that the purchase of computer software is not royalty, relying on the decision in the case of the Supreme Court in Engineering Analysis Center of Excellence case. Are we clear? Any questions, any doubt with respect to this? Yes or no? Yes, students? Yes? Any questions? Are we clear? Yes, students? Yes or no?
No, ma'am.
No? Is it clear? Fine?
Yes.
Now, if you see here, this particular portion that we have dealt is concerning the royalties, FTS, interest, all these accrued incomes, all these passive income category that we have dealt with, right? Now, just one question we'll solve from here. Miss Vivata, resident, paid a sum of 5,000 USD to Kulakshra, a management consultant practicing in Colombo, specializing in project financing. The payment was made in Colombo. Mr. Kulakshra is a non-resident. The consultancy fee is related to project in India with possible colonies collaboration. Is this payment chargeable to tax in India in the hands of Kulakshra?
Yes, ma'am. Taxable.
It is taxable? On what basis?
Consultancy fees is paid in India.
Correct. So this will become taxable in India. Fine. Okay. Let's solve the second question. Compute the total income in the hands of individual age 55 years being a ROR, RNOR and NR. Okay. So three situations we will consider. Interest on UK development bonds, 50% of interest received in India, 10,000.
Case of resident, 100% taxable. And NROR, 50% taxable. And for non-resident also 50% taxable.
Correct. What about the next one? Income from business in Chennai, 50% received in
For all the three cases, it is taxable.
all the three cases, it is taxable. Fine. Short-term capital gain on sale of shares of an Indian company received in London.
All the three cases in taxable.
Dividend from British company received in London.
For resident, it is taxable, and non-resident, not taxable, but RNOR, not taxable.
Yes, absolutely correct. Because this is from a British company and received in London. Long-term capital gain on sale of plant at Germany, 50% profits received in India.
For resident, 100% taxable, non-resident.
Yes, even for RNOR, 40,000. Profits from business in Delhi but managed entirely from London.
All cases taxable.
Correct. Income from house property in London deposited in Indian bank at London brought to India.
In first case taxable and other two cases not taxable.
Yes, correct. Because this is just remitted to India and remittance is not taxable. Interest on debentures in an Indian company received in London.
Three cases taxable, ma'am.
Correct. Fees for technical services rendered in India received in London.
All the cases taxable.
Correct. Profits from business in Bombay managed from London.
All the cases taxable in India.
Pension for services rendered in India but received in London.
Taxable, ma'am, all the cases.
Income from property situated in Pakistan received there.
Only for resident taxable and others not taxable.
Past foreign untaxed income brought to India during the previous year.
Resident taxable, others not taxable.
Even for resident, it will not be taxable because this is past foreign income.
Yes,
This
yes,
is,
yes.
like, when I was a non-resident, I might have earned this income, so this will not be taxable even for resident. Income from agricultural land in Nepal received there and brought to India.
For resident taxable, others do not tax.
Income from profession in Kenya, which was set up in India, received there but spent in India.
It's taxable in all the cases, ma'am, because set up in India.
Correct. But for a non-resident, this will not be taxable. This is only for a resident.
Non-resident, it will be not.
Correct. For non-resident, this is not taxable, only for ROR and RN1. Fine. Gift received on the occasion of his wedding.
Only for resident, it is taxable.
Correct. No, even for resident, it is not taxable. It is on the wedding.
On account of wedding, it is.
Yes.
Correct. It is not taxable. Interest on saving bank deposit in SBI.
All the cases taxable.
Yes, but you will get the 10,000 as the ATTTA, right?
Yes.
Income from business in Russia, controlled from Russia.
Only for resident taxable, others to.
Correct.
Not taxable.
Dividend from RPL, an Indian company. For all three, this is taxable.
Yeah.
Agricultural income from land in Rajasthan. For everybody, this is exempt.
Exempt N1, yeah.
Yeah. Okay. Now, moving further with respect to the other parts of this chapter, let me take you through. These exemptions, you can do it yourself, which is not, this is self-explanatory. We have discussed, few of the exemptions. Yeah. So presumptive taxation for the non-resident. There is this for the shipping business other than the cruise shipping in case of non-resident 44B, which says the presumptive income shall be 7.5% of the amount paid or payable, whether in India or out of India, to the assessee or to any person on his behalf for carriage of passengers, livestock, mail or goods shipped at any port in India, plus the amount received or deemed to be received in India by the assessee on account of carriage of passengers, livestock, mail or goods shipped at any port outside India. These amounts would include the demurrage or the handling charges, right? So both of these amounts will be included. What is the demurrage charge? What is charges are nothing but the charges in case you do not unload your materials from the ship on time. The ship vessel owner will levy you the additional charges, which is the demurrage charge. Fine. So that will be included within this amount. Okay. Now, there are two provisions which are applicable to a shipping company. One is 44B section and the second one is section 172. 172 operates like an advance tax in which, before you leave your ship from India, you have to pay some advance tax, which is done under 172, which is also nothing but 7.5% of the amount paid or payable on account of the carriage. And it doesn't include the amount received. It only includes the amount paid or payable on account of the carriage, which is in respect of that particular carriage which is undertaken. This shall be considered to be deemed to be income to in India, and before you leave, you have to take the port clearance certificate, meaning you have to file your return. The port authorities will verify that you have paid the taxes, and then only you will get the clearance certificate to leave the ship from India. So if you pay any tax under 172 and later on if you want to file under 44B, you can get the credit of the taxes paid under 172. So 172 is like a complete code. It includes the tax, it includes the assessment, it includes the return filing. Everything is included within that section itself. So it's like a complete code for the shipping companies. So let us take one sum to understand this. Seaport shipping line of non-resident foreign company is engaged in the business of carriage of goods shipped at Mumbai port. During the year, it collected the freight of 100 lakhs, demurrage of 20 lakhs and handling charges of 10 lakhs. The expenses of operating its fleet were 110 lakhs. Compute its income under 44B. So what you will do is you will take the 7.5% here of your total receipts, which is the 100 plus 20 plus 10, which is 130 lakhs. And on that, you will pay the tax, which will be as per the tax applicable to a foreign company. Are we clear? So that is about 44B. Clear?
Yes.
Next is 44BB, which is for the mineral oil company, exploration of mineral oil. Here the present given as. So here same as 44B only, but you have the 10% rate which is applicable. So yes or no? Next is for the aircraft, 44BBA. 44BBA provides a flat rate of 5%, again on the similar line as we have seen for the shipping business. Let's take a sum on this. Mr. Q, a non-resident, operates an aircraft between Singapore and Chennai. He received the following amounts from the carrying of the business of operation of aircrafts. 2 crores in India on account of carriage of passengers from Chennai. 1 crore in India on account of carriage of goods from Chennai. 3 crores in India on account of carriage of passengers from Singapore. And 1 crore in Singapore on account of carriage of passengers from Chennai. The total expenditure was 6.75 crore. Now, you will not consider the expenditure because you are going for the presumptive rate, which is 5%. So, 5% we will carry on the amount paid in respect of the carriage of the goods, livestock or passengers from the port in India, right? So what amounts you will carry and then what amounts you will consider, and secondly amount received in respect of the shipment from the any port outside India. So what are the amounts that we will include? Whether we will consider 2 crores?
Yes, ma'am.
Yes. We will, yes. Then what about this 1 crore?
Yes, ma'am. Yes.
Correct. 3 crores?
Yes, because it is received account of
1 crore?
from passengers from Chennai.
Correct. So we will include it. Fine. So here you will include all these amounts, and on the 7 crore rupees you will pay the tax. So you will consider the profits of 5%. Are we clear? Yes or no?
Yes,
fine.
ma'am.
Next is the
There
presumptive
is a
for the
second part to the question, right?
yeah. So that just says that whether the business, if the business was carried on by a foreign company, would your answer be different? Answer would be the same because 44BB
Same rate.
does
Okay.
not distinguish between the non-corporate and the corporate assessees. So answer will remain the same. Next is the for the civil construction turnkey power project, the presumptive rate of 10% is being given. And the last one is the business of operation of cruise ships. See, we had seen for the other ships, it was 7.5% under 44B. Under 44BBC, we have for the cruise ship. What are cruise ships? You like have everything inside like a hotel or, big stay facilities, all of that. That's nothing but the cruise ship. This is a special provision which is introduced, which provides for the 20% presumptive rate for the companies operating in the cruise business. Clear? Everything else remains the same. Can you offer the lower profits than the presumptive rates? So they say under civil construction, and under this thing, extraction of the mineral oil, you can offer the lower profits, lesser than what is given under the section. But for shipping, aircraft, cruise ship, you cannot offer lower profits than what is prescribed under the section. Clear? Next is deduction in respect of the HO expense. So let's say, for example, you have a branch here in India, you are making the payment to the head office. So you will get the deduction of the expenditure paid to the head office, right, under 44C. But there is a restriction. What is the restriction? 5% of the adjusted total income or the actual expenditure paid, whichever is lower. Now, what is the adjusted total income? Total income without considering the deduction of unabsorbed depreciation, family planning expenditure, which is unabsorbed, brought forward business loss, speculation loss, capital loss, or specified business loss, or any deduction under Chapter 6A. And the total income which is there will be considered for the 3 assessment years in the case where you have the loss in the current year, right? So you will consider the average adjusted total income. Where if it is available for 2 years, then you'll consider for 2, right? Then what is the head office expenditure? Head office expenditure is basically the expenditure in relation to the payment to the head office, which is in respect of rent, repairs, salaries, travel expenses, all of that. Okay, so this is how the HO expenditure is allowed. Let us solve a question and understand more through that. The net result of the business carried on by a branch of a foreign company in India for the year was 100 lakh. After the charge of the HO expenses of 200 lakh allocated to the branch, explain with the reasons the income to be declared by branch in its return for the AY 25-26. So how will we solve this? So here we will consider the adjusted total income. What is my adjusted total income? 100 lakhs loss plus I'll add back 200 lakhs. So what will happen?
100 lakhs profit.
100 lakhs profit, right? So 5% of the 100 lakhs or the 200 lakhs which is actually paid, whichever is lower. So we'll consider here 5 lakhs. Are we clear? Okay?
Yes, ma'am.
44DA, we have already seen with respect to the FTS when you have the permanent establishment. Next is the capital gain taxation for non-resident. Here you have the applicability of the first proviso to section 48. What does it provide? That if you are a non-resident and if you have invested in the shares of the Indian company or debentures of the Indian company using the foreign exchange, then in that particular case, you will get the foreign exchange fluctuation benefit. What is the foreign exchange fluctuation benefit, students? Foreign exchange fluctuation benefit is that what we will do is we will convert our cost, our sale consideration and expenses on transfer using the foreign exchange rate as on the date of acquisition, date of transfer or date of transfer for the full sale value. What is the rate that we will use? SBI, average of SBI TTBR and TTSR. You will convert every amount into the foreign exchange, calculate the capital gain, reconvert the capital gain into INR using the TTBR. And then that will be your final capital gain. Are we clear? So basically what we are trying to do over here, let us understand again through the sum. Mr. A non-resident, remits US $40,000 to India on 16 September 2006. The amount is partly utilized on 3rd October 2006 for purchasing 10,000 equity shares in A Limited, an Indian company, at the rate of 12 per share. These shares are sold for rupees 48 per share on 30th March 2025. FMV of these shares on 31st Jan 2018 was rupees 35 per share. The TTBR and TTSR rate they have given, they have asked us to calculate the capital gain on the assumption that these shares have not been sold through recognized stock exchange and these have been purchased and sold through a recognized stock exchange on 2 assumptions. So first we are going to consider if they are sold through not sold through a recognized stock exchange. So what we will do is First, we will consider the computation for the purposes of the capital gain if they are not sold to the recognized stock exchange, right? So here, what is the sale value that I have? These are sold for 48, right? How many shares are there?
10,000.
Correct. So what is my sale consideration?
4,80,000.
Correct. So now I will not consider 4 lakh 80. I will convert this amount into the US dollar using the TTBR and TTSR average as on the date of transfer. What is the date of transfer? 30th March, right?
30th March.
What is the TTBR, TTSR? 59 and 61. So 59 plus 61 divided by 2. So what I will do is, I will take 4,80,000. So 59 plus 61 divided by 2 comes to 60. Right? Average of 59 and 61 comes to 60. I will divide by 60 to get at the foreign rate. It comes to $8,000. Fine. Now what is my cost of acquisition? 12. I purchase at 12 per share. Correct?
Yes.
So 10,000 into 12, I will divide by the average of TTBR and TTSR as on the date of purchase. What is the date of purchase? 3rd October 2006. So 19 plus 21 divided by 2, how much comes to? 20.
Yes.
Correct? So 12 into 10,000 divided by 20. This will give me the US dollar amount of purchase. So 8,000 minus 6,000 is 2,000 my gain. This 2,000 I will convert it again into INR using the TTBR rate as on the date of transfer. 38th March is the date of transfer, 59 rupees is the rate. So 2,000 into 59 is my 1,18,000. This is as per the first proviso to 48. Are we clear? Yes or no? So this is what you have to do. Now, when the shares are purchased and sold through a recognized stock exchange, what will happen in that case? You have to tell me.
Means Indian rupees, we have to convert it in Indian rupees, and Indian rupees, we have to do the sum, solve this.
Indian rupees, we have to solve the sum. So this is in Indian rupees only. We don't have to convert now.
Yes, as per Income Tax Act, we have to do.
So you will not apply first proviso to 48. When the shares are sold through a recognized stock exchange.
Buying rate and selling rate we will not use, no?
Why? Why we will not use? Yes. So when the shares are listed on a recognized stock exchange, yes, in that particular case, which section becomes applicable for long-term capital gain? Yes, students.
$48, ma'am.
No, 112A.
Yes.
When you sell and purchase through a recognized stock exchange, you have long-term capital gains under 112A. Correct? So if it is 112A, in that particular case, you will not get the benefit of first and the second proviso to 48. Isn't it? So, if you look at this table, when you transfer the listed securities right? When you transfer the listed securities, in that particular case, you will get the benefit of the first proviso to 48 only when it is not covered under 112A. Because 112A doesn't give you benefit of the first or the second proviso. So, if you transfer through the recognized stock exchange, the STT will be applicable, and 112A says you can't claim indexation or the foreign exchange fluctuation benefit. So, in the second case, you will not be able to get the benefit of the first proviso. Even when you transfer the unlisted securities, you will not be able to get the benefit of first and second proviso both. It is only when you will transfer the listed securities, but otherwise then through recognized stock exchange, only then you can get the benefit of first proviso. So it has a very limited applicability. Are you getting it? So that's the reason why when they say that it has not been sold through recognized stock exchange, then only you will be able to get it. If it's an unlisted security, still you will not get it. If it is not listed only, it is when not sold through recognized stock exchange, you have done an off-market transaction where 112A is not applicable. In that case, only you will get the first proviso. So when it is purchased and sold through recognized stock exchange, simple calculation, 4,80,000 my sale consideration, and this is purchased prior to 2018. So I will take the FMV of the shares, which is 35 as on 31st January 2018, right? So I will take lower of 3,50,000, which is the FMV, or 4,80,000, which is the sale consideration. So 3,50,000, and higher of the cost of acquisition or the FMV. So I'll take 3,50,000, right? And that will give me simple long-term capital gain, which is exempt up to 1,25,000. So over and above 5,000, it will be taxable at 12.5%. Are we clear, students? Yes or no?
Yes, ma'am.
Fine. Then we have second provision, which is the special provision under Chapter 12A. Now, this is applicable for a non-resident Indian. Non-resident Indian mean a person who is a citizen of India or a person of Indian origin, but at the moment he is a non-resident. Indian citizen or a PIO who is a non-resident. This chapter is applicable to them. What it says is that on the long-term capital gain, on the long-term sale of shares, right? On the sale of the shares or debentures, which are purchased using the foreign exchange. Long-term capital gain on the sale of shares which are purchased using the foreign exchange or debentures, there will be a lower tax rate of 12.5% if the transfer takes place after 23rd July. 10% if it takes place before 23rd July. Are we clear? And on any investment income in respect of those shares or debentures, it will be 20%. On the gross basis without allowing any expenditure. Here, you will also get the benefit of the first proviso to 48 because you have purchased those shares and debentures using the foreign exchange. This section does not restrict you the benefit of first proviso. But you will not get any Chapter 6A deduction. Are we clear? Yes or no? Fine. Plus, here you are not required to file the return of income also if you have paid the proper taxes, TDS is deducted, and this is your only income. So, exemption from filing the return of income. Now, if you sell this asset, if you sell these shares or debentures, you will get the exemption under 115F if you deposit within the 6 months the sale consideration in the new asset. Right? So if you have a long-term capital gain and within the period of 6 months, you have invested the amount in another shares or debentures of Indian company, then in that particular case, the exemption under 115F will be capital gain into cost of new asset divided by the net consideration, just like your 54F. But if within the 3-year period, you sell the new asset, new shares, then the capital gain which is exempted earlier will now be considered as the long-term capital gain and will be charged to tax in the year when you transfer the new asset. So let us take this example. A non-resident Indian acquired shares on 1/1/2009 for 1 lakh in foreign currency. These shares are sold by him for 3 lakh on 1st January 25. He invests 3 lakh in shares on 31st March 2025 and these shares are then again sold by him on 30th June 25 for 3 lakh 50. Discuss the tax implication. Ignore the first proviso to 48. Here they are asking you to ignore. If in the exam it is not asking you, you have to calculate the effect of first proviso. Clear? So here my sale consideration is 3 lakh minus the cost 1 lakh. So 2 lakh is my long-term capital gain. I have invested entire 3 lakh. So of course my capital gain exemption will be restricted to 2 lakh. Clear? Now if I sell this 3 lakh 50,000 in the next year, right? So what will be my capital gain? 350 minus 3 lakh short-term capital gain of 50 plus this 2 lakh which is exempt will be considered as long-term capital gain. Are we clear? Yes or no? Clear?
Yes, ma'am.
Fine. Now, even if you become a resident, right, then also you can furnish a declaration that I want to be continue to be governed by this particular chapter. And this chapter will be applicable to you. This tax rate will be applicable to you for all the years until you sell those assets which you have purchased using the foreign exchange. If you want to opt out, you can opt out of this particular chapter itself, even as a non-resident. You can select under the return of income that you do not want this chapter to be applicable to you. It will not be applicable to you. Clear? Any questions, any doubts so far? Yes? Fine? Okay. Next section is income from the bonds or global depository receipts purchased in foreign currency. What are global depository receipts? Which derive the value from the Indian shares, right? If you want to list your shares on the US stock exchange or foreign stock exchange, that's not permissible. But what you can do is you can issue the GDRs or ADRs, which they can list it on the foreign stock exchange, which will derive the value from the Indian shares, right? So what they say is that 115AC says that the income which is there by way of dividends on those GDRs or income by way of long-term capital gain arising from the transfer of the GDRs will be taxable at the rate of 12.5% for the long-term capital gain after 23rd July and 10% in respect of the dividend. And this will be again taxable on the gross basis, meaning you will not get any Chapter 60 deduction, any expense deduction, but you will be exempted from filing the return of income in India. Are we clear? Now, understand one thing, one point which I just want to link it over here. If you are transferring the GDR, if you are a non-resident, and if you are transferring the GDR to a non-resident, then in that particular case, it is not regarded as transfer under section 47. So under 47, if you transfer the GDR to a non-resident, it will not be regarded as the transfer. Are we clear? Yes or no? Fine. Now next is special provisions for the foreign institutional investors. So if a person is a foreign institutional investors who are investing in the stock market, who are basically, the portfolio investors wanting to, trade in the stock market, for them, income in respect of securities other than in respect of the mutual funds, it is taxable at 20%. Short-term capital gain from the transfer of listed securities, it is taxable at 30%. Income by way of transfer of the short-term capital gain, which are covered under 111A listed securities, it is 20% after 23rd July, 15% prior to that. Long-term capital gain other than 112A, 10%. Income by way of long-term capital gain which are covered under 112A exceeding 1.25 lakh, 12.5% after 23rd July, 10% before that. And any other income will be taxable at normal rate. Again, this is taxable on the gross basis. Right? Now, here one important point that you have to remember is the surcharge. Right? So, the highest rate of surcharge on the STCG, LTCG, dividend, right, even if it is exceeding 2 crores, will be restricted to 15%. Will be restricted to 15%. Also, in case the FPI are incorporated as the AOP, which is only consisting of the other companies as its members, the rate of surcharge will not exceed 15% even when the income exceeds 1 crore. Are we clear? Yes or no? Is this clear? Here also you will not get the benefit of the first and the second proviso to section 48. Here also you will not get the benefit of the first and the second proviso to section 48. Fine. The last section which we are dealing today is the taxation for the non-resident sportsman or sports association. Here you have a 20% rate in case of income of a sportsman from participation in any game in India other than the crossword puzzles and all, because that is covered in a 115BB. Income from the advertisement. You see, like a lot of foreign players are there. Messi is there. You see their advertisement in India. Whatever income they will receive will be taxable at 20%. Contribution of any articles to any magazines, journals, newspapers for a sportsman, that will be covered under 20% if he is not a citizen of India and is a non-resident. Any non-resident sports association deriving any income from the guaranteed paid in India, right? So in relation to any game or sports, again covered under this. Any entertainer who is not a citizen of India and is a non-resident, income received from his performance in India. So if you see any kind of, like, we have seen that these days, there are many, like non-resident performers which are coming to India, right? And they are doing the performances in India. For example, Dua Lipa, right? Or if you look at Ed Sheeran, recently you would have heard this song Sapphire, right? So all these, if they, generate the income from any performances in India where they do these stage performances, in that particular case, this will be taxable at 20% under 115B, the double BA. Are we clear? This will be taxable on gross basis and no deduction will be allowed in respect of Chapter 6A as well. You will be exempted from filing ITR if this is your only income and the TDS has been duly deducted. Fine. Any questions, any doubts that you have, please feel free to ask me. Otherwise, we can just close the session. Yes? Fine. So let's stop here for today. And tomorrow again, we have a class, same time, 6 to 9. So we'll, cover rest of the things tomorrow.
Yes, ma'am.
Yes, ma'am. Thank you.
Thank you so much.
Thank you so much, ma'am.
Yes.